All right, folks, I want to make a video about implied volatility. And I want you folks to understand that implied volatility is the single most important factor in options pricing. Unfortunately, there's a lot of people who trade options who don't know anything about implied volatility. And I was one of them many years ago. Since then, it's been at least I don't know, 10 years since I first learned what implied volatility really was about, but I literally traded for about 6 years, 7 years prior to that without ever, and I literally mean ever, even knowing that there was a such thing as implied volatility, which of course was a disaster, but it is what it is. Now, let's go over that. What is implied volatility? Implied volatility is the amount of volatility in an options price that an options price is suggesting, is insinuating would be the volatility of the stock that the option is written on. So, in other words, the stock itself has its own volatility level, and the options prices may not reflect that exact level. They might be reflecting a higher level of volatility than the stock actually does, or they might be reflecting a lower volatility than what the stock actually does. When you go into earnings, there's a very reliable, consistent pattern that you will see with options going into earnings. So I want you to look over here. Every one of these options change. The May 14th, May 21st, May 28th, June 4th options change. You look over the right, you can see the implied volatility levels. I'm using the think back feature from Thinkorswim to be able to show what the data was at that time. So for EA, it had earnings released after markets on the 11th. And what you'll notice is that when I go forwards by one day to the 11th, you'll notice that the implied volatility levels over here are going to change. So notice that all of them dropped. The implied volatility levels dropped after earnings. They were higher before earnings, then they drop after earnings. Okay. Before earnings, you're going to see an inversion of the normal pattern of implied volatility. The normal pattern of implied volatility is you will see implied volatility levels going up gradually as you go farther out expirations. But when you're near earnings and you have options that will expire just before or on the day of earnings, the implied volatility levels will be highest for those options and they will go down as you go farther out to later expirations. The reason for this is simple. When you have earnings, you have a known event that could dramatically change the price of a stock. It's imminent, everyone knows where it is. So therefore, there's a greater risk to an option seller going into earnings that they will be assigned on an option that they sold. If I sell a call or I sell a put going into earnings, if the stock moves far enough, I might end up being assigned on that option that I sold, which of course would suck if I don't want that. So if that's the case, I need to make sure I'm charging enough premium when I sell my options to compensate me for the additional risk I'm taking. I'm placing this, allowing selling options right before an earnings event. Okay, where I know the stock can make a dramatic move. Normally, the risk is forwards. In other words, normally the risk in the market gets greater the more time that you look into the future. But when you're in earnings, the risk gets kind of shifted to that particular event. And then after that event, things will return back to normal. What's causing the implied volatility levels to change is not because lots of people are buying options to speculate on earnings. That's something a lot of people seem to think, but that's not actually reality at all. The reality of why implied volatility levels change is that yes, demand can influence it, and strong demand will influence it. But in actuality, the real reason implied volatility levels go up or down is primarily because the market is pricing in the amount of volatility that it expects, because that's what options are doing all of the time. No matter when we look at them, all options contracts have a pricing in of the amount of volatility that is expected for that stock. And also, if options are very illiquid, if they're not very frequently traded for a particular stock's options, then the implied volatility levels will tend to be high because the sellers of those options will insist on higher prices since they don't know when they're going to be able to get out of the stock of the options they just sold. Okay, in a regular highly liquid stock like Apple, If I sell options right now and I can buy them back very quickly. So if I'm a market maker, that's great for me because I'm not locked into that contract for very long. So I can afford to offer more competitive prices if I'm trading a stock like that. But if I'm trading a very illiquid options, I'm going to have a really high offer and a really low bid. And the idea is that if anyone's crazy enough to take my offer or sell to my ultra low bid, fine, you get it. But now I'm expecting the stock will never move far enough in either direction that this person is going to make any money. And I'm probably going to be right too. So implied volatility levels are a direct connection to the price of the option. If the price of the option is increased, in other words, if a trader perceives that earnings are coming, that the stock is going to make a big move or a significant move, and they're pricing in a certain amount of movement, they price that into the options. They start quoting at the right price that they see as fit. And then that, of course, moves the implied volatility level up. Okay, it's the aggregation of all of the market participants' expectations of the future that's primarily driving implied volatility up or down. Anytime a risk event is coming, it doesn't matter if people trade tons of options or none at all. It does not matter. The implied volatility will still go up. And if you're not sure that that's true, there's an easy way to prove it. Look at the volume of options traded for any stock you want going into earnings and look and see if there's any significant difference between the implied volatility change of options that have zero trading activity and the options that have significant. Now, there will be one difference that's noticeable, and that is the bid ask spread should get tighter the more the options are being traded. But the implied volatility levels will basically be very close. So, for example, if we look here at the options for EA going into earnings, we have the volume at 8 here, 1,000, 2,800, etc. So basically we have volume of trading, sure, but notice that all the implied volatility levels are elevated. So when we pass through earnings, what do we see? The implied volatility levels across the board all drop, even for the options that show very little trading. In other words, could we realistically say that 14 trades is is what caused this big implied volatility drop, or 19 trades this one, or it's not rational for us to think that that's the reason why. Okay, we can actually observe that it's not. And more importantly, if you're in the business of quoting prices for people to trade off of, you know this already. You're already thinking ahead. You're already pricing in what you expect, and the market is going to just have to pay you whatever you believe is your risk. So if I look here, we had options prior to earnings for this particular strike. They traded 28 volume, right? That was the total amount of volume, only 15 open interests. This is the implied volatility before earnings. And then after earnings, it drops down to 33 with zero selling. No one sold. It was zero volume. And the others did the same thing. Here's the 135s. They had 3 contracts traded on this day, right? Whereas the day before, they had 3 contracts as well. So am I to believe that those 3 contracts were enough to change the implied volatility to drop it by 20 percentage points? Of course not. Why would any person who's quoting this price even consider moving their price that much lower if there's no demand? But that's not the reason they moved it lower. They're moving it lower because the event's over and the price is being adjusted. So I point this out for a reason. It's critical that if you're going to trade options, you definitely need to know what implied volatility is and how it changes. You also have to understand that Vega is what dictates how much the options price will change if you see a drop in the implied volatility. But remember, the implied volatility number itself is dictated by the price. The price is what makes the implied volatility number. And Vega is basically just saying that when you see a change in the price by a certain amount that causes the implied volatility level to drop by 1 percentage point, that the amount that the price will have to change is 5 cents. So usually we think of it a little differently. We think that the implied volatility goes down and the options lose 5 cents. But what it's more accurate to say is that if the price is dropped by zero point zero 0.05 cents, that will equal a 1 point drop in implied volatility. So it's better to think of it in the reverse, because that's actually what's happening. So if someone has a pricing model for options, right? They're quoting bids and asks all day. They're saying that they'll let you buy at this price and sell at that price. And how are they coming up with those numbers? Where are they coming from? Their bids and offers. Simple. They're calculating their risk. They're calculating what type of movement might occur. They're looking at upcoming events. They're calculating all the different variables to give a forecast of the expected range of a stock over a period of time. And that range of movement is reflected in what we call implied volatility. So implied volatility is what you get when you plug in the pricing data and some other data into the equation, and it spits out, well, based on that and based on some other data, this is the implied volatility. This is what the option is implying that the stock's volatility is, even though the stock is often going to be trading either below or above that number, but almost never will the stock be trading at exactly what the implied volatility is for the options that are written on the stock. Okay. So again, it's more accurate to think of it that way, because the pricing models, for example, if you've got a pricing model, you've done the calculations, and that pricing model basically tells you, okay, if the volatility of the stock will have changed by this much, you should increase the premiums that you will charge by X amount. If you just plug in the volatility component into your options pricing model, it will then spit out what the actual um, prices you should be buying or selling at should be, right? And that, by then, when you enter those quotes into the market, into the exchange, then the exchange takes those quotes, and if your quotes are matched by other quotes, and you guys have an aggregate price right here, bid ask there, then the exchange, or actually the software for the that we're using here, Thinkorswim, just takes that data from the exchange and reverse engineers to tell you, okay, this is what the implied volatility level is based on these prices, and this is what the vega is, again, based on all the other information. Okay. So although it's better to think of it that way, in practice, all you got to do is say, well, if this number goes down, forgetting what's over here, if all I know is that this number went down from 36 to 26, I know for sure that that's going to be a 50 cents drop in the value of these options. That's what that's telling me. So if nothing else changes, if the stock stays exactly still, it's 5 seconds later, and this thing dropped from 36 implied volatility to 26, then I would know that that means that the price of those options went down by 50 cents. Okay. Now, when you go into earnings, that means that the amount of movement that the stock will experience has already been estimated. And if the market is dead wrong, if they're far off from what actually happens, like what happened with UPS, then options buyers, whether you're buying a straddle, if you're buying a straddle or a strangle, it should work out really well in that situation. Whereas if you buy a call or put, will dictate whether or not you win, of course, is which direction you bet. So if you bet up, you bought calls and and the stock goes up, then of course you make money. But if you bet the opposite, of course you would lose money. So that being said, if the implied volatility level is too high, as it was, for example, with GameStop, even though the stock made a big move, if they've already priced in basically double or triple that move, even if you buy the call options, if the implied volatility levels decline after you bought them, even if the stock moves up, it will never be able to move up far enough to actually compensate you for the amount. So, for example, for GameStop, the options were essentially pricing in double the movement that had already occurred. So, in other words, you're buying options when the stock was at $400 a share, and the market's literally pricing in that the stock's going to be at $800 a share. So unless it got that far, you're not making any money. It was that they were that expensive. So hopefully this helps. I know it's like a lot of information, but you really have to focus your attention on that. That implied volatility is a reflection of what the market believes is going to happen to the stock. The implied volatility is basically derived from the price, and the price itself, of course, is derived from what people expect to happen when they plug their equations, they plug the data into their equations about a stock, what it's been doing, etc., and they choose to put a quote to buy or sell. That's where all that's coming from. Once you know that, then you know why implied volatility goes up before earnings, why it goes down after, and what you can do potentially to exploit it. Okay. So I hope that helps, folks. Thanks. Bye.